Hey, Dr. E here. Let's continue on with Chapter 7, Section 2, Capital Structure, and we're looking at equity. So let's move on with this lecture. All right, so we learned in Chapter 2, which is accounting. We reviewed, didn't learn, you should know that by now. You've had 205 and 206, so don't put that information into your brain and then dump it out after the exam. You got to remember some of this accounting stuff, some of this basic accounting stuff. So the owner's equity section, you need to know which financial statement owner's equity is on. There's the income statement, the balance sheet, the cash flow statement, and the owner's equity section is on the balance sheet. And if you don't know that, then you need to go back and review Chapter 2 on the financial statements. So owner's equity consists of cash contributed by shareholders. That's why it's called contributed capital. It's not cash that is earned. It is cash that is contributed when stockholders buy stock. Okay, so that's one line on in that section, the owner's equity section of the balance sheet. And then cash generated or earned by the company, retained earnings. So as I've said many times in this class, the accounting terms mean something. It's earnings, and you know which financial statement reflects earnings that the company makes. That comes off of the income statement. So earnings, income, they're synonyms. So it's earnings, and you know what the word retained means. It means earnings that are kept. All right, so that's on in the owner's equity section. So two line items in owner's equity. We know, I've mentioned that there are different types of stock. Stock can be common stock and it can be preferred stock, and we're going to go over both types of stock. We're going to start with preferred stock in just a couple of slides. There can be more than one class of common stock. What I mean by that is when you buy stock, you need to make sure what class of stock you're buying. There's A class, B class, C class. What you can do as an owner is you can cut a deal with other owners on different types of stock that gives people different rights. Rights to different dividends, rights to different voting. So you can use your imagination in business to cut a deal. There's not only one way to cut a deal. So that's what different classes of stock is. It's when you have different rights associated with your stock, okay? So again, as I was saying, different classes have different voting rights, different dividend rights. So let's go back to that. So I want to make the point again that you can use your imagination to cut deals. Business is about being creative, imaginative, cutting deals. Okay. So let's go into preferred stock. All right. So preferred stock is considered to be a hybrid security, and when you see that word hybrid, it means that something has traits or characteristics of more than one thing, okay? So if you're a fisherman, and I used to fish quite a bit, there's a hybrid bass, and it has traits of a white bass and traits of a striped bass, okay? So it was created. Same thing with a preferred stock. It has traits of equity, common equity, and it has traits of fixed income, so it's called a hybrid security. All right, characteristics of both debt and equity. All right, so like debt, preferred stock is typified by having a fixed dividend. It is a dividend that does not change. Now we know that with common stock, if a company's doing well, often the companies increase the amount of the dividend. Not so with preferred stock, it is fixed. Okay, like debt, the security for the owner of a preferred stock is above that, more senior than that of common equity. In other words, when a company goes bankrupt, a line forms out the front door. All the people who are owed money by the company, they get in line, okay, and they want to get paid. They want to get their money back. The question is, where will you be in that line? And you want to be closer to the front of the line. The people at the back of the line who are the common stockholders, most often they get nothing, okay? So you want to be close to the front of the line. And if you own preferred stock, you'll get paid back your money before the common stockholders will. All right, no voting rights by the preferred stockholders. They don't get to elect the board members. That's common stockholders. And the rating agencies, there are companies out there that assess your securities to see how safe they are, to see if you as the issuer of the company is in a good position to pay the interest or dividends and the principal back. And so you want to have a high rating. And so preferred stock is often rated for credit risk. Credit risk means, can you pay your interest and your principal? That's what credit risk is. All right, sometimes these companies have what's called a sinking fund. And let's see if we, so a sinking fund, we talk about this in the bond chapter. A sinking fund is when a company systematically, over time, buys back the securities. They retire the securities over time. Very common with debt, but often with preferred stock. The companies will issue the stock, and then over time, as the companies deploy the capital in a productive way and they make a nice return on that capital, they take the excess cash flow that they earn and they buy back the securities to reduce the amount of principal that's outstanding. That's called a sinking fund. All right, so like equity, so we've covered now the ways in which a preferred stock is like debt. Now let's talk about how a preferred stock is like equity or common stock. There's no maturity date on a preferred stock. There is maturity for debt, there is no maturity for common stock, and there's no maturity for preferred stock. That means there's not a date at which the company promises to buy back the preferred stock at the price that they sold it to you. Okay, so there's no agreement on that. Once you buy it, it's yours. You want to sell it, you're going to have to sell it to somebody else through the marketplace. All right, unless it's called in a sinking fund situation. All right, the dividends are not guaranteed. The board has to meet and vote on the dividends. Now, missing a dividend, it's a big deal. Not a good thing for a company, but they're not guaranteed. And the dividends are not tax deductible for the company, so it makes it more expensive to use preferred stock than to use debt. All right, and the seniority of preferred stock is below that of debt. So the seniority is above that of common stock, but below that of debt. Why do companies issue preferred stock? To raise capital. Okay, sometimes there are investors out there who would rather use preferred stock than common stock. They would rather use preferred stock than debt. I'm talking about the investors. And so companies need to meet the needs of investors, and they will do what companies do what they have to do in order to raise capital. So some companies issue preferred stock. So it's a pretty frequently, commonly used way to raise capital for companies. All right, some other features of preferred stock. Here's a cool feature. It's called cumulative. Again, use your imagination. Come up with ideas. Cumulative means that if a company decides not to pay a preferred stock dividend, they do that because they don't have the cash flow, or they must have a more urgent need for the cash, then they will use they'll discontinue or miss a dividend payment. And so if they do that with the preferred stock, then they have to accumulate any preferred stock dividend that they miss, and they have to pay the preferred stockholders any back dividends before they can pay any dividends on common stock. So it's a good idea. It's a protection for the preferred stockholder. If you miss a dividend, then you have to make that up before you pay anybody else. Okay, so it's a protective covenant, a promise. All right, a lot of preferred stocks are convertible, and that means that the preferred stockholders are given the right in the contract to exchange preferred stock for a specified number of shares of another security, usually common stock. So you can go in, the contract says that for every preferred share that you own, you can exchange that for a ratio, a certain number of shares of common stock. And so sometimes people will like to buy the preferred stock to get the high dividend when a company is new or going through a tough period, they'll get the high dividend. And then once the company starts doing well cash flow wise, then you can go in and exchange your preferred stock if you want. You don't have to. It gives you the right but not the obligation for common stock for you to get capital gains. Okay? So this is called a sweetener. This is what companies do. They attach it to a preferred stock issue in order to appeal to investors, to get investors to buy the preferred stock. Okay? So here's another feature of preferred stock. Some of them are callable. Again, this is a debt type of attribute or feature, callable. And callable means that the issuing company, it's real similar to a sinking fund. It allows the issuing company to buy back the preferred stock at a specified price. The difference between a call feature and a sinking fund is a sinking fund is a schedule. It's a mandated schedule that companies have and they have to stick to it. A call feature is much more flexible. Companies don't have to buy the preferred stock back. So callable and sinking fund are similar. They do the same thing where a company goes and buys the preferred stock, but callable, the price is fixed. Sinking fund, the company buys it back at whatever market price is out there. Callable, companies have more flexibility. Sinking fund, they have more of a schedule. All right. So again, callable just allows the company to retire those securities. All right, so how do we value a preferred stock? The good news is it's a really simple formula, okay? Again, the value or price of any security, of any asset, is the present value of expected future cash flows. So what will the cash flow be on a preferred stock? And the answer will be the annual dividend, okay? And it's fixed. There's no maturity date, okay? So it is a perpetuity. So we looked at that way back in chapter 4, I believe. It might have been chapter 5, okay? Probably chapter 5, because a perpetuity is an annuity, same payment, same time frame, never ends, okay? That's what a perpetuity is. So the model to value a perpetuity is PO, the price you should pay today, is equal to D1, which is the next expected dividend. And the next expected dividend, the dividends are all the same for preferred stock. So D1 equals D0 equals D2 equals D3. Every period the dividend is the same. We simply divide the dividend by the cost of preferred stock, which is your IY, your required rate of return. So here are the definitions for these letters, okay? So KP is the cost of preferred stock, otherwise known as the required rate of return, or your IY, your discount rate that we learned about in chapters 4 and 5, your discount rate. How do you get your KP? Well, you take your D1, you divide it by PO, and this is otherwise called or referred to as the dividend yield. When you take the dividend on a stock, or a common stock or a preferred stock, when you take the dividend and you divide it by the current market price, that's called the dividend yield. And actually what you do is you take the dividend, the annual dividend. Most preferred stock, most common stock and preferred stock dividends are paid quarterly, okay? So you take the last 4 dividends, that would be your annual dividend, divide it by your current stock price, whether it's preferred stock or common stock, and you get what's called the dividend yield, and that also reflects the required rate of return on a preferred stock. All right, so here's an example. What should be the current price, theoretically the intrinsic value, the real worth, the market price of a preferred stock that will pay a $5 dividend, $5 annual dividend? And by the way, this would be called a $5 preferred. When you hear that term, a $5 preferred, they're not talking about the market price of the preferred. They're talking about the annual dividend. And in the investment business, they will refer to a certain preferred stock as, in this case, a $5 preferred. It's not the market price, it's the annual dividend, okay? So let's assume, so we have the dividend, it goes in our numerator, and now we have our required rate of return, okay? A lot of times I'll give you that required rate of return. Sometimes I'll give you the dividend and the current market price, and I'll ask you to compute the dividend yield, which is the dividend divided by the market price, and that is your K, or required rate of return. In this case, it's 15%, okay? So here's your answer, PO. The market price, the theoretical market price today should be D1, the $5 divided by KP, the 15%. So here it is, $5 divided by 15%, $33.33 is a fair price to pay, okay? All right, many preferred stocks will pay dividends on a quarterly basis, as already mentioned. So you have to adjust the dividend and your required rate of return so that the time frame is consistent. In other words, you have to take a quarterly dividend. I got these students who keep coming by and making faces at me through the window. So you got a quarterly dividend, and you got a quarterly required rate of return, or you have an annual dividend and an annual required rate of return, okay? So your dividend and your required rate of return have to be on the same time frame. Here's an example. A company pays a $2.50 dividend quarterly, all right? The annual KP is 10%. Well, we got a problem because we got a quarterly dividend, but we have an annual required rate of return. We cannot put those two together, but what we can do is make an adjustment, all right? And the adjustment we make is we're either going to annualize the dividend, which means we're going to take the quarterly dividend, multiply it by 4, and then divide it by the annual required rate of return, and we get our fair price. Or we take the quarterly dividend and we divide it by the annual dividend divided by 4. We take the annual dividend and make it quarterly. So quarterly, quarterly, annually, annually, okay? And we come up with the same price. All right, so you got a homework due. There you go. All right, so we're gonna stop it there. We're gonna move on to common stock in the next lecture. Thank you and have a good afternoon.